Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. As always, I highly encourage you to go check out the Loonie Hour because much of what I discuss here, we go in depth on the podcast. We are really trying to grow that community. I think it is probably the best Canadian macro finance podcast in the space. But that's neither here nor there. I want to touch on this week, of course, to everyone's chagrin, the Bank of Canada coming out this past week. Again, shocking and mystifying, global markets and everyone in Canada, big bank economists. I mean, I'm going to imagine the amount of angst in the comments after this video about how many people are upset and disgruntled and disgusted that the Bank of Canada opted to keep rates on hold despite everything that's going on, right? I mean, I don't need to remind you that inflation just last month printed basically 5%, a 30-year high in the consumer price index, national home prices ripping at all-time, the pace of home price inflation. Not only is it up 26%, which has been the fastest pace on record, but in the first, 2, 3, 4 weeks here of the new year, prices are ramping up at an accelerating pace. Again, you kind of have this escape velocity. I would argue that Vancouver home prices in the past 4 weeks alone are up 5 to 7%, and that is not an exaggeration. It is very, very alarming, very concerning. And so the Bank of Canada had every excuse. You had everything there to hike interest rates, and they didn't. But again, don't get all upset about the way it is and the way it should be. It is what it is, and I've been warning people for many, probably going on several years now, really since the writing's been on the wall that this is kind of the end game. The end game is that they're trying to keep this long-term debt super cycle on life support. It's really been this, global financial system has essentially been on life support since 2008. So central banks continue to basically, again, you've had a zero interest rate policy now since 2008. We've been running bouts of QE going on 13 years now. And it's not going to stop. It will continue. There will be pauses here and there and financial turbulence in between, but it's going to continue. So, with that being said, don't get me wrong, the Bank of Canada here moving forward, they are going to hike rates in March. That's essentially a guarantee, more so just to save face. Because again, you have to at least provide the illusion of solvency, right? You have to at least, at the end of the day, fiat currencies are, they're faith-backed currencies. Yes, they're backed by, a government, which that government has to have the general populace's confidence and control. And so, yeah, okay, sure, they're backed by the military. But at the end of the day, a dollar is it's a liability of the state. And so you have to at least maintain the faith in that currency. And again, I think that lack of faith ultimately is showing up in asset prices. But the Bank of Canada will hike here in March. They'll probably hike again, as I've said before, 2, 3, maybe they get 4 hikes in. And that still leaves you with an overnight rate, around 1%. So, and I think we're going to run into turbulences as we start to get up into those numbers. So, we're going to talk on that, but people ask me, what does this mean for housing? Ironically enough, keep in mind, this is all kabuki theater, right? I mean, the fact that every question that gets asked to the Bank of Canada during these press conferences is pre-scripted. They're pre-scripted questions. They're all softballs lobbed up, right? Nobody asks hard questions because, if they do, they're out the door and they don't get their question even answered. And the journalist wants to obviously stay employed. And so during this whole press conference, 45-minute long press conference, Q&A, there was one question asked on housing. Again, this should be front and center of every central bank, right? Housing. I mean, we've got this massive unaffordability problem. I think everybody's well aware that, these home prices are growing to these exorbitant levels. One question, and I'm going to clip to that question right here.
Hi there, can you hear me? Yes, Michelle.
My question is, on BNN, we've had a lot of mortgage experts saying that there's been an increased demand for variable rate mortgages. So some of these borrowers are thinking the bank is not going to hike as much as the market thinks. What would you say to those people?
I'm going to ask Senior Deputy Governor Rogers to take this question.
Yeah, thanks, Michelle. So, as the governor said earlier, we're not in the business of giving financial advice, whether to take a fixed or variable mortgage rate. As it relates to housing, I think our forecast is clear what we see the path for housing to look like. Housing activity has been elevated for a while now in Canada, and housing affordability has been a persistent problem. You can attribute it to a number of things. Certainly low interest rates is one of those factors. A recent spike up in prices has also brought investors into the market, more investors into the market. That's something the bank has published research on recently. Overall, the bank's view is that the most important thing that will restore balance to the housing market in Canada is an increase in supply. Supply has not kept pace with demand, and we think that's an important thing that needs to happen. So we're encouraged by recent conversations in that direction. But overall, coming back to the forecast, we think housing activity will stay elevated for a while. Certainly, our message today that interest rates are on a rising path will feed through to mortgage rates and likely moderate demand over time.
So notice Tiv Macklem dodges the question, passes it off to Carolyn Rogers, who basically says, overall, the bank's view is that the most important thing that will restore balance to the housing market in Canada is an increase in supply. Supply has not kept pace with the demand. In other words, don't look at us, we aren't responsible. Again, it's a supply and demand equation, and the bulk of demand is driven by mortgage credit availability. And so when you hammer rates to zero and you keep rates at zero and you have inflation running at 5%, again, arguably let's call it 10% because that's the real number, you've got a real cost of borrowing of about negative 8% for housing. So of course, you're going to see a massive asset bubble that forms. And so the Bank of Canada, in my opinion, is largely responsible for what's been happening, along with the federal government in their mismanagement of the economy. But that's ultimately what's drive house prices. It is the supply of housing certainly plays an influence of that, but the largest determinant of that is the demand side, which is the availability of credit. Because if you think about it, most people need a mortgage to buy a home, particularly in Vancouver when your benchmark price of the typical house is $1.9 million. Most people are not paying cash. Most people are getting a mortgage. And so it's the availability of mortgage. It's no coincidence that mortgage credit growth in Canada, again, is running at 13-year highs, and you've got all-time record highs followed suit, that the two and two are coincided. Again, let's keep in mind that over really the past 18 months, there really hasn't been any immigration into Canada. The official statistics which show 400,000 plus, immigrants approved or PRs or whatever, most of those people were actually already here, living here. They would just have their visas basically fast-tracked. So you just had this massive run-up in home prices with really the borders completely shut. That's number one. Number two is, what does this mean for the housing market here moving forward? As I said this on the Loonie Hour as well, is that if you're looking for sort of the housing market, the winds starting to change, so to speak, we have to understand the mortgage market in particular. So right now, your 5-year fix is at about 3%. It's gone up quite a bit, and that's going to start putting some weight on the housing market, particularly for suburban houses that have doubled over the past 18, 24 months. The problem is that your variable rate today is still about 1.3, 1.4%. So as Carolyn Rogers indicated, today you have about 55% of all new mortgage originations going in the variable mortgage rate space. And so most people are seeing the spread. Well, I can get a variable today at 1.3, or I can get a fixed at 3%. So you're getting more and more people into that variable rate mortgage. That variable rate mortgage is basically only changes and influence when the Bank of Canada actually hikes interest rates or overnight interest rate. And so let's just play devil's advocate or play a scenario through here. If they start hiking in March, 25 basis points, and let's say they go again, they've got 7 more meetings for the rest of the year. Again, this is going to be an autopilot. It's going to be 20. If they were to hike rates, it'd be 25 basis points, 25 basis points, 25 basis points. And so even in like 5-6 months from now, you're probably looking at the overnight rate at, let's say, about 1%, which is, 75 basis point increase. That still brings your variable rate to roughly about 2%, just over 2% if the banks start to discount what they do on the variable side of things. So this isn't going to filter through into the housing market for quite a while. And so we're stuck here in January with the lowest inventory ever on record across the nation, mortgage rates at rock bottoms, and it's going to take time for that to filter through. You have to keep in mind that most people have rate holds for 90 days. And so they're already kind of locked into these previously older, lower mortgage rates. And so this is going to take time to play its way through. I think where you start to see, again, the tightness in the housing market, the conditions start to change, is when you get mortgage rates north of 3%, arguably on both products, fixed and variable, and it holds and stays there for an extended period of time. So that's really what I'm watching on the residential housing side of things. Now, I want to touch on one other thing to put kind of the pieces together, because, I'm going through on Twitter and people say, oh, better be careful, don't go variable rate interest, don't go variable mortgage rate, interest rates are going way up. It's the same people that obviously have been calling for Bank of Canada rate hikes for the past 12 months that have been dead wrong. And I say, yeah, you know what, that's probably true. I definitely agree that rates are going to be going up here, but until you realize the largest borrower in Canada is the federal government. They are, in fact, the largest borrower. And so let's go through their most recent fiscal report, which is actually just released today, ironically, the day that I'm filming this video. So everybody comes out celebrating that the fiscal deficit in Canada in the first 8 months of this fiscal year for the federal government. Everyone's going, yay, the fiscal deficit, it's been almost cut in half. The fiscal deficit for the first 8 months of this calendar fiscal year was $74 billion, $74 billion deficit. And then you start to look back and you go, hold on a minute. That's more than double. A $74 billion fiscal deficit is more than double what it was during the 2008-2009 global financial crisis. So we are still running financial crisis type budgets. They're completely out of whack. And so let me play another scenario for you. So you've got this fiscal spending that's going on. That fiscal spending is dependent on low rates, right? The government issues bonds at these ultra low rates. They have to then pay interest. They have to service the interest on this debt at these ultra low rates. Now, I have a question and a scenario for you. Federal net debt in Canada is just about nearing $1 trillion. Today, it's technically, if you ask Google, it's about $950 billion. So let's just call it, for simple terms, $1 trillion is the net debt outstanding for the federal government. Let's just assume that rates effectively double from here, right? Let's go with Scotiabank and say, hey, the Bank of Canada will hike rates today from 0.25% today, where they are right now, to 2% within the next 12 months, let's call it. So I'd love for somebody to just run the simple numbers and say, okay, let's take this $1 trillion of outstanding debt and multiply it by, significantly higher rates, going from basically, whatever they've issued on that debt. Let's just call it even a doubling on that debt. Where does that leave the fiscal situation in Canada? So now, under this scenario, let's assume again that the Bank of Canada's overnight interest rate is 2%. And given the level of indebtedness, particularly amongst households in Canada, let's assume that because of that, mortgage rates are now trading at, let's call it 4%, 4.5%. What does that do for the housing market? I would argue that prices would be down minimum 20% across the board. what does that do for the federal government's tax revenues? Because under that scenario where real estate makes up a massive component of GDP, and obviously there's the tied-in wealth effects, right? When your house price goes up, you refinance it, you go buy the boat, you go on vacation, you go buy a couple nice new pairs of shoes. And so under that scenario, what does the federal government's tax receipts look like in a scenario where housing essentially crashes? Does it get better or does it get worse? The answer is that the federal deficit budget just gets even blown more out of whack. So not only are they paying more on their debt servicing, that more and more of their tax receipts are going in to pay for the debt outstanding, but not only that, their tax receipts are actually falling because the economy is in a deep hole because, higher rates have crushed the economy. And so now, run this third scenario, which is Google the level of interest expense as a percentage of total tax receipts that triggers a sovereign debt collapse. Because that's really what you have sort of playing out, is that there's just the federal government, the largest borrower, and then you've got math. So the only other way under that scenario, if you have a scenario where tax receipts are falling, interest expense is way up, budget deficit gets blown out, even worse, your only two options are, again, to basically hit Control P, get the central bank to essentially monetize new debt issuance. Or number two is you have basically go through a period of austerity. Now, I don't think the Trudeau government, in particular, that is currently in power, has any sort of appetite to run austerity type of programs. And if you look at it, and a lot of this is like, you look at the budget, the revenues and expenses here, the Canadian government. A lot of this is just these social programs, right? It's healthcare, it's pensions, it's seniors care, it's universal basic income, but it's employment insurance benefits, it's elderly benefits, it's child benefits, it's recovery benefits from the CERB, it's health transfers, social transfers. You just go through their financial snapshot here. These are all social programs that can't get cut. They're liabilities that you really can't print. And so I think this is ultimately the bigger picture to understand is this isn't about really Canadian households and wanting to keep the housing party going. It's just a matter of solvency. That's all it is. And that's really hard for people to understand. You're not going to hear that, on CBC News. You're not going to stir a bunch of, pandemonium and scare people about, an incoming global debt bubble that it's going to go. At the end of the day, Canada, along with many other countries, have massive debt to GDP burdens. We are seeing, I think, the bursting of these sovereign debt bubbles, and basically central banks and federal governments trying to act together in unison to basically prevent this from happening. So what's happening is basically central banks are suppressing the level of interest rates, and governments are artificially creating GDP by running massive fiscal deficits. And these deficits or this debt issuance that's issued by the federal government is basically monetized by the central bank. And so this is the only way to basically try to derive any sort of growth to keep basically a debt bubble from collapsing on top of you. And so that is the bigger picture that I want people to kind of take away from everything that you read from, the big banks and the Bank of Canada. Just understand that most of these people, a lot of them are political actors, that this is the ultimate reality of where we are today, that there is no going back, unfortunately. There's no going back to normal levels of interest rates. There's no going back to a world of zero QE and unwinding balance sheets and singing Kumbaya. That just doesn't exist. And so as I'm looking forward here, I do worry about the pace of growth in the housing market. But I also look at the bigger picture and say they're kind of stuck either way, because at the end of the day, if housing goes, they're gonna have to print. But doesn't mean there won't be periods of time where we'll have to go through some pain. So again, I hope I kind of put that together for you, bigger picture. As always, appreciate your support. We'll see you next week.